Well, without further ado, I would like to welcome, and I'm truly honored to welcome the president and CEO of VF Corp, Mr. Bracken Darrell. Thank you so much for joining us today.
Thank you, Tom. Thank you very much for having me. Well, I
I
like
know
the
you
announcement. I feel like the Chicago Bulls opening when Michael Jordan was there.
company very well. VF Corp has major, incredible brands, Vans, North Face, Timberland, Dickies, and a lot more. Mr. Darrell will speak with us about that. But I do know that you're on a timeline, so I want to get right down to some of the questions and give our investors as much valuable information as we can. We've heard your quarterly earnings call. Congratulations on a great quarter, by the way. The turnaround is going along exactly as you promised when you took the helm just a couple short years ago. One of the core things, I'm going to start with compensation, and most management would say, uh-oh, here we go, but it's just the opposite. We're really excited about how VF Corp has set this up. And one of the core things we look for in potential investments is the overall alignment of management with shareholders. Are they acting like owners, and do they respect shareholder equity? Since joining VF Corp in 2023, you have personally written over $3 million worth of checks from your own pocket to purchase stock, and several other board members and executives have made material open market buys. You have a policy requiring significant share ownership over a 5-year period, ranging from 2x to 6x current annual base salary, with credit given only for direct holdings. On top of that, 90% of your compensation is tied to financial targets, including revenue, operating income, gross margins, with 50% of stock option awards linked to long-term performance goals. The rest of the executive team has similar performance-based compensation. Can you speak to how you and the board think about alignment with shareholders and why you believe this culture is so important for the VF Corp turnaround?
I don't know if most people are as financially motivated as a lot of investors might think, but certainly some people are. But in my experience, good boards and good leaders understand that the scorecard for winning is about increasing shareholder value dramatically. And so whether they're there because they want to make a ton of money or they're there because they want to be viewed as a big winner, both of those arrive at the same place, which is you should absolutely have the performance tied to the performance of the stock. And so and the performance of stock is usually a direct reflection of the growth of the top line and the growth of the bottom line. So I couldn't feel any more strongly that, especially the CEOs, but also, the rest of the management team should be very directly tied to that. And we are. And I think every company really ought to be.
Yeah, I agree, and I'm really happy to hear you say that. When I got involved in the stock, pre kind of tariff fears, I was just sharing with your colleagues that we've got a pretty low basis, $13 and change across the board, and we saw you start to implement the turnaround plan, and the stock ran up from 13 to 28, and then there were some fears about tariffs, and it got knocked down. But when I originally wrote this, and I wrote a personal check, and I wrote big checks for my clients to buy stock, my basis, and by the way, my nickname on Wall Street is Turnaround Tom. So we do have something in common, as you're a turnaround specialist as well. I had originally underwrote this. I said, look, the number one thing with the turnaround is take solvency risk off the table. So I underwrite for that first. If they do that, you get a double. If they actually stabilize the business, you get more than that. And if they execute and grow and turn it around, you can get upside. But my initial underwriting was, $40, $50 stock. Okay. And as I've listened to you over the quarters and seen what you said you were going to do and see what you've done, leaving aside the short-term liberation noise and all that stuff that you're going to work through just fine, I've taken my internal underwriting up from that 40-50, because you've already taken solvency risk off the table. You're already stabilizing and growing most of the brands. I think I can't tell you if it's going to be 3, 4, 5, 6 years, but generally 3 to 5 years, I think this stock could work its way back to new highs. And I know you can't guide on any of that. Little bit of curveball here. When you forget about the guidance, forget about it. You're an individual investor. You wrote $3 million worth of your own money into stock. Did you have a similar view to me, or do you think I'm too optimistic?
Well, yeah, since I can't talk about, oh, I
Yeah.
can't, I could, but it'd be naive of me to go out and start predicting stock prices like that.
Yeah,
I,
fair
won't-
point.
I can't really respond directly to that comment to your question, Tom. But I'll talk about why did I invest.
Yeah.
I invested for a couple of reasons. First, I think I wouldn't be here. First of all, you deserve the name Turnaround Tom because you've invested in turnarounds serially and they've worked. I don't think I deserve the name. I'm not Turnaround Bracken because I really never go into any of these with that first objective, that double objective. That is not my objective.
Yeah.
In fact, I just view that as like if you're on a stairway, the turnaround part of it is the first two or three steps. That's just a path. That's just part of the pathway to what I really want to do. I love creating long-term growth businesses. I mean, that's my game.
Yeah.
That's all I'm here for. That's all I ever cared about in my life from a career standpoint. I love to grow people. I love to grow businesses. I love to grow brands. I love to create great things, great products. So that's why I came here. It wasn't to do the turnaround. The turnaround's just a step along the way. So
Love it.
so that's I guess my starting point. My second one is in terms of the investment itself, I would say, uh, as a result, I think we're a tremendous investment, or I wouldn't put my own money in.
Love
I
it.
also wouldn't be here if I didn't feel that way. So I feel like it's a tremendous investment, as you said. We're trading at kind of not historic lows, but at pretty low prices relative to even 4 or 5 years ago.
Yeah.
And the brands are fantastic. I mean, we really have tremendous brands. So
Yeah.
that's about all you need. The rest is really leadership, getting the right team in place, and then putting the process in place and executing. And I
Yeah.
think I can know how to do that. The most important one is getting the right people here. And we definitely have, at least at the top now, I've really got a fantastic team.
Great. We're going to get to that here. Something we always prioritize at Great Hill Capital is investing in companies with high quality sound management, what we call betting on the jockey. And that's exactly how we view VF Corp, because by all means, Bracken, you're a turnaround specialist, whether you want to call yourself that or not. Turnaround Darrell, let's leave that aside. We're going to call you Growth Company Darrell. But for those in the audience who may be less familiar, Bracken's first major turnaround was Old Spice, where he tripled market share in 2 years, creating one of the most successful turnarounds in P&G history. Then he took over Logitech in 2013 when the stock was down 82%, sales were declining, operating margins had collapsed. Over the next 8 years, the stock went from $5 to $133, delivering a 26-bagger. The setup sounds very familiar to what you faced when you joined VF Corp, a stock that had fallen 85% with declining sales and operating margins cut in half. Could you first discuss what you've learned from your track record of successful turnarounds, and now that you're approaching the 2-year mark at VF Corp, compare and contrast your plan, execution, results, and results to date, and expected outcome between Logitech and VF Corp to date, Logitech being a 26x because of you. Maybe kind of draw some comparisons if you see any.
Well, the most important, what have I learned today? What have I learned in my experience? The most important thing is great. If I've learned anything, and I've been very lucky to work around great people, and I had great people at Logitech, and I built that team over probably 5 or 6 years, to really get it to where it was. The team that really had that kind of performance. It didn't take 5 or 6 years to perform, but it took 5 or 6 years to get there. And it probably didn't need to take as long as it did, but that's just intuitively how I felt like the timing that made sense. Here, I've gone much faster on the people side. I'd say it's taken me, really a year and a half to get to the same kind of caliber team. Um, and that team is still over there at Logitech, and I've got a super team here now. So I feel really, really good about that. So those two things are very parallel in terms of what we've done so far. The second thing is it ends up being all about if you think about it, the requirement to be financially disciplined aside, so we'll park that for a second because that's a given. If you think about it, we only do two things. We create products that ideally make people feel better about themselves and are preferred to other people's products. And we create, we help build brands that people want to join, want to be part of. And those are the two things we have to do exceptionally well. And so to do that, you've got to have a great product machine. So one of the first things we really worked on here is let's, first of all, and we didn't have this problem last year, let's get to one product process. It's as if we had, 13 different factories or 32 different factories for creating products. And they were all doing it differently. We've gone to one now. Now that's still not fully implemented because it takes a little while to cross over and get to that common practice. But it's a best practice. It's a best industry practice. And so by the time we get to, over the next 6 to 12 months, we'll be on that one common best in class process of ideating and creating product and bringing it to market. That's the most important step from a process standpoint you can do in this company. And I feel super good about that. Now we're going to do that for every major process in this company. We are. So think about that like you open your phone and you've got apps on the phone. Once you've got one really good process, it's like an app. And so every time there's an improvement to that process, you can update all the different brands, apps or processes at the same time.
Wow.
So that's where we're headed. And that's really going to be a good best practice. I dreamed of doing this before when I was back at P&G a long time ago. And P&G generally had one good, strong process.
Yeah.
Ever since I experienced that, I wanted that in every company I was in. Logitech, we didn't have that problem because we were on one process. Here we didn't. We weren't. So we've done that. So that's the second step we've made. So first people, second processes. The third is functional excellence. Is really bringing in people who are the best in class of what they do and making sure that we're constantly pulsing the industry and outside our industry in areas, let's say, for example, AI today, where the best things that are happening, we're bringing them in, learning them, and then becoming functionally excellent in them. Those three things are super, super critical. And, we're well downstream on all three of them. I would say all three of those were really critical to the performance of Logitech. The second one was easier to do because we were already on one process. We just had to improve it. And then the first, the people side, the functional excellence side took years to develop, and that's exactly what we're doing here.
Thank you. Well, that's really, really helpful. I want to talk a little bit about the cleanup phase, which you've been going through the last 24 years. Probably the one you hear the most about, and arguably the biggest piece.
24 months.
Yeah, 24 months.
I think some investors feel like it's 24 years, but it's been 24 months.
24 months, exactly. No, it's been very, very short time, but a lot accomplished in that short time. But the one you probably hear about most, the piece of the turnaround, biggest piece of the turnaround, and that's Vans. I now have 5 pairs, by the way. I picked up another pair at Vans by Talia in Laguna Beach this weekend with my girls. This is a brand VF acquired back in 2004 that went on to grow 10x over the next 15 years. So, from starting in the early 60s, and yet they were able to drive that growth. But it's been under real pressure since, as you know, revenues in the most recent fiscal year were more than 40% below their peak. In fiscal year 2022, you've been open about what went wrong, that Vans lost touch with its core audience by chasing trends, became overexposed to value channels, which diluted the brand and leaned too heavily on legacy franchisees. Since you stepped in back in 2023, the focus has been on taking your medicine and cleaning things up, from existing value channels and closing unprofitable stores to right-sizing inventories, all of which have helped to drive significant gross margin improvement. Could you speak to that initial phase of the Vans turnaround, what you prioritized, what you think needed fixing most urgently, and how you've approached setting the brand up for a comeback?
Yeah, I think this happens a lot in very successful businesses. That it's like the thing that gets you there, you overdo it. It's like you get a really, really strong muscle, and then you just keep going and going and going. And then suddenly one day you're so overdeveloped that the rest of your body's in trouble.
Yeah.
And that's exactly what happened here. And I think they did some really great things with the brand. I mean, the Warped Tour, just fantastic. They have fantastic products that were really appealing, and they did really good things with them. And then they just again, it's so easy to be 2020 hindsight. I'm not critical of anybody who was here at the time because, oh, for the grace of God, it could have been me.
Yeah.
But I think they had a few things that were really working, and rather than keep that innovation funnel filled, where you're constantly putting in new ideas, well, innovation ideas on the product, innovation ideas in the marketing. They had things that were working, and they just poured more and more fuel into those. And they took them broader and broader in distribution, for example, into deeper into the value channel. And they just went deeper and deeper and deeper and broader and broader and broader on some of the same styles. And there wasn't something behind them.
Yeah.
It's just they had cut the spending, or at least they hadn't increased spending on the innovation pipeline. And the problem is at some point that music stops. So that's really what it was. And if that sounds overly simplistic, I don't think it is.
Yeah.
The cool thing is the brand is as strong as ever. It's a fantastic brand. You really have a very hard time finding anybody who doesn't think the brand is really strong.
Yeah.
That's a great sign. That's like a
Yes.
wonderful sign. And the business is in trouble, but the consumers don't seem to realize that, well, why is the business in trouble? The brand's good. I just don't see anything I want to buy right now. That's a good sign if you like to create products, because it means we can come back.
Yeah.
And then the marketing side of it is just getting people trying to find your way into the cultural excitement that's happening in the moment. Trying to lean into that. I'm not a big believer that you can create big, broad trends usually as a company. Sometimes I think people maybe they pull that off, but you can usually find them and then align your brand with them, and then do things that consumers see as really fitting the moment. And so that's really what we're up to now, and it's super exciting and fun.
Yeah, that's great. Well, thanks for commenting on that and the cleanup. I want to talk a little bit about growth. The focus seems to be on creating new products and returning the brand to its roots in many ways. It reminds us a little bit of what New Balance pulled off in recent years, maybe
Yeah,
Converse to a lesser extent. After 15 years of sale declines, they reinvented themselves, New Balance, that is, by leaning into streetwear culture, influencer partnerships, and high profile collaborations. In terms of returning the brand to its roots, it doesn't get much clearer than bringing back the Vans Warped Tour. You sold out 3 events in a matter of hours and drew nearly 170,000 attendees in Long Beach, more than double the previous peak. You've also introduced new core franchises like the New School, now your #2 global franchise and top growth driver, along with sellouts like Super Low Pro. I have a pair, by the way. I think I sent you a
good.
picture. And continue to successfully lean into the premium product space. On top of that, you've rolled out several high-profile collaborations, including Lil Uzi partnership, and continue to elevate the marketing approach. As we head into back to school and holiday seasons, what should investors expect to see from Vans as this brand work starts to materialize? Are there any early signs of traction you can point to, and how should we think about the early influence of Sun Cho as she begins shaping the brand's direction going forward?
First of all, Tom, you've made the same mistake I did. It's Sun Che. When I
Sun
introduced
Che, excuse
when I
me.
when I
Okay.
introduced Sun, she corrected me. I introduced her to whatever thousands of employees at Vans, and she said, Bracken, I hope you realize it's. I think she said Darrell. I think my name is Sun Che, and I said, oh no, I appreciate that. My name's actually Bracken Darrell, not Darrell Bracken. So, we still laugh about that. Look, I think the New Balance example is fascinating. I think it's one of the most successful growth stories I've ever heard of. And I grew up with New Balance. I'm old enough to remember when New Balance was just a running shoe, and what they call a dad shoe today not never a shoe I actually ran in, but I remember the brand, and it was a very narrowly targeted running shoe, and they stayed that way for a very very long time. And I knew the prior CEO quite well, and he left to run Purple, I think, and the new CEO took over, and it seemed like just miraculously it took off. And so I studied that one with my team because we found it just a fascinating example. But there are a lot of examples. The cool thing about this industry, there are good examples of brands either getting their mojo back, or getting mojo back and a lot more, like the New Balance story, or creating mojo, like On, or creating mojo after quite a long time, like Hoka. It's a cool industry where when you start to get things right, things really can take off. And so it's another thing I love about this industry is people are interested in enough that that can happen, and we all spend enough marketing to help make that happen. So. I can't comment directly on back to school, but you asked for early signs. I mentioned this in our earnings call. You know, we started here really trying to move things just like we did at Timberland at the really kind of the top of the curve. So when we at Timberland, I'll use as a parallel, when I first got here, we started doing these, it was the 50th, 60th anniversary of the boot. And we started doing collaborations with some of the best, hot designers, not people you never necessarily heard of, but they're really known in the design community or the fashion community. So we did 8, I think, of those in a row. Kind of month after month, we put them out there. It was our birthday, it was hip hop's birthday, it was the hip hop, it was the Boots birthday. We did a little movie that very few people saw, but it was one of the coolest movies on the planet. So we did a few things there, and that was really intended to kind of seed the very top of the industry. And then, thank God for Pharrell and Louis Vuitton, and they reached out to us and said, "Hey, we'd really like to do something with you guys." And that created the next wave in Paris. And then Maisie Willoughby, who's our brilliant CMO, or working with Nina Flood, who's our brilliant president. Nina had this idea, hey, what if we bought out all the billboards and put Je t'aimes instead of Je t'aime? If you don't speak French, Je t'aime is I love you. Je t'aimes is I love Tim's, I guess. It'd be kind of the equivalent. So we bought out all the billboards in Paris, all at the attempt to try to get our mojo back.
Yeah.
And it worked, and then Timberland started to come up again. A lot of we're doing the same thing at Vans, where we started with a sub brand called OTW, stands for
Yeah.
Off the Wall. We brought cool collaborations; they all sell out immediately, and so we've been doing that now for a year and a half. And the cool thing is now in Paris this year at Fashion Week, where a lot of the industry comes together, we had the tier zero, the top of the industry, people who want to carry our OTW product. We were up 50% in booking, 50% in meetings there, and we had people that had not carried us in years who came back and want to carry it now. So it's
Wow.
just a good sign. It's like I mentioned in the earnings call. It's a good sign that things are happening. Now that is a sliver of our business. It's not going to have any meaningful impact in absolute dollars volume of profit on the Vans brand if we sell 3 times more of those. But
Right.
the fact that they're interested. Trends start at the top. They don't usually start at the bottom. So it's going to flow down, we believe. We'll see. We'll have to prove that.
That's great. That's great. Well, thank you for that color. Looking now, I want to go into the reinvention. Looking back when you first joined VF, you threw in the kitchen sink quarter and took all your medicine at once, resetting expectations, cutting the dividend. You launched Project Reinvent, which focused on 4 priorities: delivering $300 million of fixed cost savings, strengthening the balance sheet, creating America's regional platform modeled after the successful EMEA and APAC operating models, and driving sustainable growth through Vans turnaround. Now, nearly 2 years in, you've delivered more than $300 million in cost savings earlier than originally expected, deleveraged the balance sheet by selling Supreme for $1.5 billion and reducing the debt by over $2 billion, and are on track to reach 2.5 times leverage by fiscal 2028. You've successfully implemented the Americas regional model, and 2 of your 4 largest brands have now returned to growth. You've emphasized having a high say-do ratio since day one. Could you speak to your experience leading this turnaround over the past 2 years and walk us through the key stages, starting with cleaning up and resetting the table, and now what investors should expect as the focus shifts to returning VF back into a growth company? I'm going to call you now Growth Darrell.
Good. I think one of the key things that happens to companies when they get in trouble is they get really good at growing, the top line for a long time. And as a result, they also get good at growing their SG&A for a long time. And then when they stop growing or they start to decline, they continue to be good at growing the SG&A. So it gets out of whack.
Yeah.
And nobody is as flexible as they want to be in adjusting SG&A to the top line. So taking out, $300 million of SG&A was just a must, and it was the same thing at Logitech when I was there. So and by the way, it was the same way at Old Spice long ago, my first turnaround to growth. So that was like job one. but then, then it comes, then you get back to a lot of things I already talked about, which is, once you get your cost in line, you get it, if there's maybe the most important number in any P&L, in my opinion, and you're a financial expert, I'm just a guy who works in businesses, but I think the most important number in a P&L is the gross margin because
Yeah.
everything's captured in that. It's like looking at DNA. If your DNA is healthy, then and interesting and suggests you're going to have a strong, high level performance in health and longevity. That's a very good sign. And I think gross margin is the DNA of a company. It shows you how strong your brand is. It shows you how strong your products are. It shows you how strong your pricing power is. There's a lot in that. So I am very fixated, admittedly, on gross margin. So we worked hard to figure out how do we get our gross margins back where they need to be, and we have specific targets we're after. We've been pretty public about those. And when we hit those targets, we'll be at 55%, 45% SG&A, and we'll be at 10% operating income. That was with no growth from where we were then. So I believe we're really well on track to doing that, and that's connected to that 2.5 times leverage that we're planning for 28 or
Yeah.
below. And
Yeah.
so all of this is like on a very logical path to get to the point where the real starting line is, which is it's all about growth. It's
Yeah.
all about growth. It's always all about growth once you get the fundamentals right from an SG&A standpoint and a basic cost standpoint. So today we are all about growth.
Yeah. I love it. I love it. And you did lay that out in Reinvent to Growth, two medium-term fiscal year 2028 targets, reaching 55% gross margins and more than doubling operating margins to 10%. What stood out to us in these targets is that they're entirely based on cost savings and assume zero revenue growth. If our math is right, even under that highly conservative scenario, this business would earn close to $2 a share from the margin expansion and cost savings alone, which in our view would support a stock price more than double current levels. Obviously, don't comment on that. You've also noted that each additional $1 billion of revenue or 10% growth could drive an extra 1.5 to 2% of operating margin improvement. That becomes especially relevant given the 3 to 5% growth outlook for the broader apparel and footwear market over the next few years, alongside VF's own category expansion, whether it's North Face aiming to 2x apparel and equipment and 3x footwear, or just taking market share with stronger product and brand execution. So between a growing market, category expansion, and share gains, it's hard to see a scenario where VF doesn't participate in the growth. My question is twofold. First, is that a fair way to think about the earnings power and upside from your medium-term targets? And you can be as vague as you want. And two, are those fiscal year 2028 targets still firmly on track? How are you thinking about progress so far? And given that the targets are primarily driven by cost savings, how are you approaching tariffs and potential mitigation strategies, especially considering 85% of the U.S. volume is sourced from Southeast Asia and Central and South America?
First, yes, we're still on target to those
Love it.
goals we're on track for those goals as we said here in the earnings call. The tariffs are obviously not something anybody planned for. We certainly didn't contemplate them when we came to those targets, but we continue to feel like we can manage within our current game plan to deliver those targets, even with the tariffs. If I wouldn't be able to say that with any confidence if the targets affected us disproportionately to others in the industry, but it's sure based on all that we can see, everybody's kind of affected equally. So this is kind of like a big macroeconomic reality that we're all dealing with. So that means people are going to manage it just like we are. As
Yeah.
much cost as you can get, price increases where you on top of that, and in the end, that will all adjust. We'll have a short-term impact that'll last us whatever it is, a year, 18 months or something, until it's all, the divot that the tariffs immediately give you can't offset immediately. But we'll end up offsetting all of that. So that's really what we believe. And we said that during the earnings call, and we're all in to go make sure that happens. In terms of the responsiveness of this business to growth, yeah, one of the coolest things about this business in particular is it has so much leverage. It's incredibly painful on the downside when you lose revenue, and incredibly wonderful on the upside when you add revenue.
Yeah.
So that's why you could add $1 billion of growth to this business and get, 1.5 to 2 points of operating income expansion if you want to put it into that. It's there.
Yeah.
So it's a cool business from that regard. But that does make it that plus the fact that we have debt at the level we do makes it quite a volatile play going down and up. So it'll be
Yeah.
interesting to see what happens as we start to grow at some point.
Great. Couple more here as we wind down. I know you're on a timeline as well. I want a couple final on leadership. A players tend to follow other A players, and since you took the helm of VF Corp, the company seems to have become a magnet for talent. In fact, including you, 12 of the 16 leaders on the global leadership team are either new to the company or in a new role. That includes Sun, who's now global brand president of Vans, who joined from Lululemon after nearly 7 years as chief product officer during a period which revenues quadrupled. And the brand became one of the most respected in the apparel space. Or Chris Gobble, the new brand president of Dickies, who came over from Gap after helping lead its turnaround. The list goes on, but what's clear is you've built what looks like an all-star leadership team. That said, could you speak to what this new group brings to the table that may have been missing before, the kind of culture you've worked to build, and the difference you've seen as this leadership team starts to show its impact?
Yeah, I think they came for a couple of reasons. As you said, A players tend to be more likely to hire A players, but I think the more important factor is great brands with great potential tend to attract people who love great brands, and I think
Yeah.
that's the bigger driver. I'd love to give me and Brent Hyder, who's our head of people and the head of North America, of the Americas too. I'd love to give us both a pat on the back, and I'll give him one because he does amazing things. But I think it's just as much the fact that we've got such amazing opportunity here, and people smell that and they love it, and that is super super exciting. In terms of the team itself, I think what I really believe is that great teams are made of people who feel super excited about what they're doing. They feel the potential. They feel enabled by the company more than hindered by it. Since I've spent my whole life in relatively large companies, I have an incredible, maybe because I have an incredible bias against bureaucracy. I hate bureaucracy. I hate long meetings. I hate big decks. I hate all that stuff. So I really do all I can to try to create this little, um, uh, I'm trying to think of a better word, but quicksand of big company reality
Yeah.
as possible. The least amount of process, but good process. That process I talked about earlier, we were 32 to 1. Well, the goal is not to have one really thick process. It's to have one thin, clean, streamlined process. It's the least process is the best process, not too little, because you need good process. I would love that, but I think the error that most big companies end up with is they just get to keep it. It's like you end up after a while you end up like a hospital that's been there for 30 years. Somebody gave the heart wing and somebody else gave the dermatology wing, and where it's like 10 different buildings all kind of stuffed together. And I've worked in enough big companies to have felt that myself, and I'm doing everything I can to avoid that. I want this to feel like a pristine, brand new building that you walk in and feel transparency and flexibility and empowered and fast.
That's great. A little bit on touching on North Face here before we go, switching gears to a brand firing on all cylinders with a whole lot more ahead of it. North Face has become the largest outdoor brand in the world. You recently laid out plans to make the North Face a true four-season brand, aiming to 2x the apparel business, 2x bags and equipment, 3x footwear, implying a 7.7 billion revenue run rate down the road. You're also coming off the Skims collaboration with Kim Kardashian, which became the fastest selling partnership in brand history, selling out within hours and generating over 10 billion impressions. Could you speak to the current health of the North Face brand, where you see the biggest opportunities for expansion, and how you plan to lean into maybe influencer-based marketing and perhaps future collaborations to drive continued brand heat?
Yeah, I'll speak for Caroline Brown here, who came in as a luxury brand expert and really came into the North Face, but she's also an athlete herself and loves the performance orientation of this brand. I think the magic of the North Face brand sits in those two extremes. On the one end, you've got this brand that started as an equipment brand, and it's probably the most present brand in the climbing of Everest, or maybe all the other really challenging climbs you can think of. We have over 200 North Face athletes, including Alex Honnold, who did free solo and climbed that incredibly scary uh, climb with no ropes live in a documentary. If you haven't seen it, please do.
Yeah.
On the other end of the spectrum, you've got people who love to wear North Face in New York, in the winter, in a subway,
Yeah.
and it's fashion for them, and it could be better. We're not doing anything in the North Face as well as we could, and Caroline would be the first one to say this, despite the fact that the business is so strong and the brand
Wow.
is so strong. There's so much unexploited opportunity in the North Face, whether you're talking about really being a four-season brand, and we can talk more about that if you want to, but really being a four-season brand, or really just exploiting the fact that we can be a much more uh, fashion-aware brand. People love to wear for how it looks, not just how it performs.
Yeah.
We're not doing either one of those nearly as well as we could.
Yeah.
And so by the way, we're also not doing nearly as well with women as we could be, even though we do sell to a lot of women. It's not that we don't, but there's just opportunities left, right, and center on the North Face where I sit. And Caroline feels the same way. And I think we've got the right team in place to make that happen.
That's fantastic. Weaker dollar, just want to touch on that before we close up. As a multinational company with 55% of sales outside the US, a strong dollar has been a significant headwind in recent years, with the dollar having its worst start to the year in over 50 years, down nearly 10% year to date. How should investors think about the potential impact if this weakness persists? Could it become a meaningful tailwind going forward?
I'm never too
Yeah.
like everything else that you can't control. I don't spend too much time thinking about it. In the short term, weaker dollar is a little better for us, because
Yeah.
obviously it improves our profitability. We do have SG&A that's dollar based, it's this dollar based. We have a lot of SG&A outside of the U.S., so that hurts us. But generally speaking, a weaker dollar is better. But I'm just not going to rely on that. I think
Yeah.
it's nice if we have it, take advantage of it. We'll make sure not to get so dependent on it that we can't be flexible and move in the other direction when it swings, because it always does.
Yeah.
So if I've learned one thing, just be on the balls of your feet and don't rely on anything you can't count on. You can't control yourself.
Love it. Love it. Is there anything we didn't ask Bracken, but you'd really like to share or talk about as we close out?
No, look, I'm obviously pretty excited about this business, and I didn't come here for 2 years. I didn't come here for 5 years. I came here to turn this into something, and I came here for a decade. Most
Wow.
investors are not here for a decade, so I'm very aware of that. That they need to see results quicker than that. But we're executing, and we're doing what we said we would do. I think we're right on track to what we need to do to be this great company that I believe we can be.
Yeah, well, we're much longer term than your average investor, Bracken. Our holding periods tend to vary between 3 to 5 or more years,
Great.
and that's what we like to see. And the last question I have to ask is, what's your personal favorite pair of Vans and why? I like my new Current Capitals. What are you wearing these days?
I am wearing a pair of premium old schools today that we just launched. Yesterday, I wear a different one almost every day. I can't even tell you how much. If you think I've invested a lot in VF stock, you should see how much I've invested in Vans shoes and all the rest of our stuff. I mean, we just make good stuff. I
Yes.
would say my current favorite is probably a pair of neighborhood collaboration Vans that are
Okay.
just very cool. They're black and I like it. But honestly, I like so many different products right now. It's hard to choose, and that's a really good place to be. And it's getting harder and harder, which is a good sign.
Yeah, well, that's exciting. I can't thank you enough for taking the time to talk with me and a lot of our investors and many people out there that really want to see the incredible value in this story. I'm now going to call you. My new nickname for you is Growth Bracken, coming to you from the heart from Turnaround Tom. I think we're going to leave it there. Thanks so much for joining.
Thank you, Tom.